My talk is going to be the case for silver miners. I want to start by thanking the MIF organizers, Metals Investor Forum organizers, for putting this on, for asking me to be here and giving me the opportunity to invite some great companies to present right after me. So let's get started. I'm going to talk about silver, but first, bear with me a little bit about macroeconomics to kind of set the stage. Debt dictates rates, and I believe that's what we're living now. Just a few examples. You look for example at the national debt in the U.S., $39 trillion. And if you look back over the last 5 years when COVID hit, and this money printing went into overdrive, in just the 2-year period from March 2020 to 2022, $6 trillion was added to the national debt. Sorry. Of the amount added, the $6 trillion, most of that was 2 to 10 year maturities. So what it meant was that they were borrowing on short term. And that, along with previously issued debt that was also either short term or maturing, means that we're hitting a maturity wall. Last year, $9 trillion of US debt came up for renewal. This year, another $9 to $10 trillion are coming up for renewal. So that's half of the entire $39 trillion debt in the US. So if you wonder why the Fed is cutting rates in the face of high and rising inflation, that's why. The ability to pay the interest on this bill is difficult enough as it is. And if you can't do it under lower rates, then your problem gets compounded even more. So that's why the Fed's been cutting rates, will continue to cut rates. And as I say, inflation's high, and even as inflation's high, they will continue to cut rates, and that's going to help, unfortunately, feed inflation even more. The Fed has a dilemma, and it's a steepening yield curve. So what that really means is that short-term bonds yield less than long-term bonds, which is the normal course of things, but that varies over time. If people have less confidence in terms of where inflation is going to be, or they think it's going to rise over time, then they want a higher return on their longer term bonds. And that's the dilemma for the Fed, because if they issue long-term bonds, they're issuing them in an environment where the rates are relatively high. So that again makes their repaying their debt that much more expensive. And this shows you just in the past year, the blue line is what the yield curve was a year ago. The red line is the yield curve now. So you see how it's dramatically steepened. Last point on macro is something I think is kind of interesting. We all think the Fed has a dual mandate, but in fact, it has a triple mandate. The dual mandate is known as full employment and price stability. But if you go back and look at the Federal Reserve Act of 1913, in fact, there's a third mandate, and that mandate is moderating long-term rates. So this is where I think things are headed. It's not something that you hear about. It's not something that they have tools that many tools for, or that they use very often. Sometimes it's once every few decades. But I believe that we should start watching for this. I think we're going to start hearing about this, and this is potentially going to start happening this year. One of the tools that they have to lower long-term rates, I just talked about how the yield curve was steep and long-term rates were high. It's something called yield curve control. And that's where the Fed steps in, starts buying up these long-term bonds. And by buying them up, it pushes interest rates down on the long end. And that makes it easier for the Treasury to issue longer-term bonds and have lower interest rates to pay on it. Now, it has other effects as well, because you can imagine when they go out and print excessively to start buying these long-term bonds, that's more inflation because they're printing to go out and buy bonds. So again, it makes it easier for Treasury to repay this debt, but it makes it very inflationary for everybody else. And in my book, The Great Silver Bull, I talk about something called financial repression, and that's what this is. Essentially holding rates down in the face of high inflation, which makes the debt essentially over time inflate away, but it makes it difficult for the average saver, especially someone who's buying longer term bonds, because the net yield to them after inflation just keeps shrinking. Sometimes it's negative. That is something that we experienced prior to COVID. So switching gears now, let's talk about silver. Fantastic chart. Over the last 2 years, silver is up 267%. I'd like a show of hands to know who's owned silver for the last couple of years. And so who's owned silver for the last 5 years or 10 years? So you're the contrarians that didn't mind being laughed at, but are now having the last laugh. So congratulations to you. You know, I decided to go back and look at where we were at Metals Investor Forum 2 years ago. Silver was at $24 2 years ago. February of last year, it was at $32 today. And I think I'm going to have to put a real-time feed in because this is changing by the minute. Yesterday, it was 88. This morning, it was 89. Earlier, when I checked about an hour and a half ago, it was 93. So I have 91. Hopefully, I'm close, but there you have it.
72.
Sorry?
93.72.
Thank you. So we have a real-time quote right in here. You're hired. 93.72. Even better. I'll take it. I thought this was a really interesting chart because it talks about the phases of a bull market. And this could be for any asset class. And it's always going to be somewhat different depending which asset and which bull market. But I thought it was interesting because it kind of helps us understand maybe where silver is to some degree. So you have the first phase is the stealth phase where the smart money comes in, is very patient, willing to wait, does the research, understands the fundamentals, and as I say, is patient, is waiting for the thesis to play out. The second phase is the awareness phase, and I think we're actually still at the very early part of the awareness phase. And I have that blue box saying "We are here," and it points to the bottom of that trough. And I think that this peak, which was obviously a lot sharper, as you saw in I believe the previous chart, is that first sell-off. So when silver, went crazy to $120 in January and now has pulled back, I think that's this time frame right here. And so it was a lot sharper, but that's what we call a bear trap. And so people basically panic. They dump their silver. And then after that, especially the ones who bought at 100 and then sold at 70 are saying, I'm never coming back. And they think it's a new bear market, when in fact, it's highly unlikely that it's a new bear market. We've gone from, I think the intraday low since January was like 67 and we're at 93 today. So there you have it. I think this has actually surprised me. I didn't think we would see this start to climb back up this quickly, this much. So the other phases after that are the mania phase and then the blow-off phase. What I think will be different in this market compared to this sort of generic chart is that the awareness phase and the mania phase are going to stretch out a lot longer than we see here. It's going to be a lot flatter. Eventually, you'll have this crazy mania peak, but I think that we're many years away from that. And some of what I will talk about in the next little while will explain that. It's true that investors have started to rediscover silver. There's not much doubt about that, given what has happened in the last few months. These are silver ETF holdings. The chart on the left is total holdings globally, and they're almost back to their all-time high, which is 2021. But I think a lot of this climb that we've seen, this gain, is especially this part here, is mostly due to buying in China and in India, where Asia in general, or you've had a lot of new silver ETFs come to market, and people have really gotten on board. The chart on the right is the SLV ETF, and that is mostly North American investors. And as you can see, it bottomed in mid-24, ran up, bottomed again. And so I think this last part where we see it climb here, this is really what we've seen over the last maybe 6 months or so. But we're far from the peak of 2021. And that tells me that North Americans in general have yet to really come to this party. but the analysts have. And, they were nowhere to be found a year or 2 years ago. Now Bank of America is telling us that we could see $135 to as high as $309 silver in 2026 based on, their estimates with the gold silver ratio. Bank of Montreal is forecasting as high as $220 silver by 2027. So they're starting to come around. And you do have some things that are very supportive on the retail side. In the US now, 401k retirement accounts now allow for physical metals. So that would include things like gold, platinum, palladium, and so on. That could turn out to be a large new source of demand. In India, for example, as of April 1st, silver will be allowed as collateral for bank loans. That really recognizes silver now as a mainstream collateral asset. It was only gold previously, and silver ETFs in India have absolutely exploded over the last probably 6 or 7 months. From August of last year, the value of their holdings are up over 320%. So people have been piling in some of these parts of the world. Now we're going to shift gears a little bit and talk about the fundamentals. I think this is important to understand how the silver the market is underpinned. Over the last 5 years, we've seen a huge shift. In 2020, 50% of silver demand was used industrially. In 2024, that was already as high as 65%. I think 2025, we don't have the numbers yet, but it'll probably be a little bit higher. So that's interesting because most of these industrial consumers don't really have options or substitutes in many cases. They absolutely need the silver that they're buying. So they're going to keep consuming it. And in many cases, they'll pay the price that they have to pay. But what is maybe more optional is the investment side of silver. So on this basis, 5 years ago, half of silver supply was available for investing. A year ago, a third of silver was available for investing. So what happens is the amount of silver supply that's available for investment gets squeezed out. But when investors come back to the silver market in a big way, which I think is what we saw at the end of last year and into early this year, they put big pressure on the silver price, and then you get a squeeze. And that's, I think, what happened. And I think we're going to see that kind of volatility happen more and more as the bull market progresses. But it explains quite clearly here how little or how much the amount of silver available for investment, physical investment, is shrinking. This is an important point, I think, as well, and how as much as silver is important to solar panels because they consume 20% of all of the silver every year, batteries are becoming a game changer for the solar market. The cost of batteries is falling by half over the next 10 years. And the uptake on batteries with solar is so rapid that in 2025, they were already at 60% of 2023 solar panel installation capacity. So the interesting thing about batteries is they're making solar baseload power. A lot of consumers, especially industrial consumers, and think of consumers like data centers, AI that is really pushing data centers. An AI search takes 10 times the amount of energy of a traditional Google search. So that's a lot of electricity. And these big data centers require baseload power. They need to know that their center is going to have ongoing 24-hour steady power. And so they've, to a large extent, turned to solar, and batteries have made that much more feasible because solar, of course, produces during the day, and you can store a lot of that excess power so that at night you can draw from the batteries. So the cost of batteries going down really is a game changer for the solar industry. So the chart on the top shows you that over the next 10 years, solar installations are going to grow roughly globally by about 3%, but the bottom chart shows you that batteries for solar are going to grow at about 12%. So that's going to allow for a lot of uptake of solar in a lot of situations. So now we're going to talk about the fun part, the silver miners. Show of hands, Who's owned silver miners for the last couple of years? It's pretty good. So I know it's true because you all have smiles on your faces. I just would not tell any of my friends because they'll expect you to pay for dinner the next time you go out. This is what bull markets can do for you. If you look at silver versus miners, in large bull markets, it doesn't even have to be the sort of the smallest companies, the higher risk players. The chart on the left is Pan American Silver versus silver. Pan American was up over 6 times in between 2002 and 2008, while silver was up about 3 times. And then if you look at the chart on the right, between 2008 and 2011, silver was up almost 3 times. Wheat and precious metals was up almost 16 times. These are 2 of the largest market cap silver companies in the entire space. This is a bull market, the very, very short-lived bull market in the silver space that was in early 2016. It lasted about 7 months, but silver was up a little over 40%. SIL was up 240%. SILJ was up 300 and almost 50%. So the SILJ had an 8 times leverage over the price of silver over those 7 months in early 2016. That speaks to the kind of leverage that you can get. So what's happened more recently? Well, if you look over the 5 years of 2020 to 2025, it's actually been pretty dismal for some of the silver companies versus the silver price, because that gray line is silver. And these are the silver miners based on SIL and SILJ. Well, in this time period, silver outpaced silver miners 2-to-1. So you had actually negative leverage, which is terrible. And certainly not why you would be investing in silver miners. Silver versus silver miners over the last 2 years, neck and neck, 0 leverage. And I think that's really about to change. And that's why, well, you being here right now is amazing timing. And I'll explain to you why. Silver miners' profits, as you might imagine, going from $30 to $90 are exploding. And I don't think the market appreciates that yet. I think we're going to get a re-rate soon. The margins are off the charts. If you look at all-in sustaining costs to produce an ounce of silver, including byproducts, you're somewhere probably close to about $20. When silver is trading at $30, those are pretty good margins. You're looking at a 33% profit margin. When silver is at $90 or $94 like we are today, at an all-in sustaining cost of $20, that's a 78% profit margin. I don't think the market realizes this yet. And over the next couple of quarters, as these silver producers start to report their numbers, the market's going to start to recognize that. And you're going to start to see significant amounts of money start to shift and flow into this sector, because it's just so productive, so profitable, so rewarding. I think that really is the opportunity. So to demonstrate a little bit more about how this has yet to be priced in. So this chart shows you silver stocks to silver ratio going back to 2016, when I told you we had that big peak in mid 2016. The silver stocks have been offering less and less leverage over the silver price right up until recently. This period here in the second half or so of 2025, starting here, you had this takeoff. The silver miners were really catching up on the silver price, and then silver exploded and the ratio went negative. So although the silver miners were doing okay, silver moved so much faster that the ratio went back down. But this next chart is an updated chart, and this is including the last month and a half or so. And you see this sort of double bottom, and the bottom is higher, and that is the silver stocks. Despite silver moving higher recently, the silver stocks have started to move higher faster than the silver price. And I think once we see a breakthrough from this line across this downtrend line, it's off to the races. And we're probably maybe a month, maybe a couple of months away if things continue the way they have been. So really lots of opportunity. Silver miners are scarce. the premium on large silver miners versus gold miners is significant. The average large gold miner is a 1.3 price to NAV premium. The average large silver miners is a 2.1 times premium. So this is an interesting quote. It's not verbatim, but it's from a guy by the name Ned Naylor Leland, who is an investment manager of Jupiter Asset Management's gold and silver fund, a $3 billion fund. And he said recently that silver producers are trading at 2 times NAV, and yet silver developers are trading at 0.2 times NAV. So just for a developer to go from developer to producer could be a 10x. And we haven't even talked about juniors at that point. So that's where I think the opportunity is. That's what we focus on. Silver Stock Investor is my newsletter. It's the only silver-focused investment newsletter. We have about 28 positions. That changes a little bit over time. But last year, most of the positions were up had at least doubled. Many of them were up 5 times. We even had one that was up 8 times. And I think it's still very early and there's a lot of upside ahead. 2 seconds on our group. I'm part of the Gold Advisor group. We're growing rapidly. I've teamed up with Jeff Clark, whose focuses on gold, uranium, and copper. We, between us, have 2 free newsletters and 2 paid newsletters. We also have a premium newsletter that is focused on private placement opportunities. I recently brought on a senior analyst who is going to be speaking later today, stepping in for Jeff Clark because he's not available. Ted Butler doing some fantastic work. We have a marketing manager, and we also have a geologist on staff now that helps us with our research. I want to leave you with this thought. Patience. This is my thought. Patience is the rarest commodity. It kind of echoes something that Warren Buffett has said before, which is that the market is a mechanism to transfer wealth from the impatient to the patient. And I think the next couple of years, that's what we're going to see in this sector. Thank you.